most people don't take advantage of this. So even though it is, and in fact, cost segregation, according to the tax code, is the proper way of depreciating your property, to break it into everything into its proper category, whether it be 5-year, the personal property, 15-year depreciation life for that's land improvements. So anything outside the building, like landscaping, pavement, concrete, fencing, signage, all that stuff actually depreciates over 15 years. The IRS says that's the proper way to do it. So even if you've been depreciating your property straight line, if you want to change that, you have to fill out a form that's called the 3115 form to go from, straight line depreciation to now doing it through cost segregation. And it's called changing it from an improper way to a proper way of depreciation.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Yonah Weiss. He is a cost segregation expert. He's also the business director of Madison SPECS. Madison SPECS is one of the nation's premier providers, experts of engineering-based cost segregation studies and Internal Revenue Service approved process for reclassifying real estate components and improvements to accelerate depreciation deductions, defer taxes, and improve cash flow. How are you doing today, Jonah? And thanks for joining the show.
My pleasure, Dwaine. It's thanks for having me on. Yeah, it's a good introduction. We are one of the leaders in the country doing this. I mean, having done over 14,000 studies since we've been in business for the past 12, 13 years or so. And so we really got a large volume going on, looking at all types of properties across the nation. So I'm very happy to be on here and share my knowledge with your listeners.
Yeah, I really appreciate it. As we had talked a little bit pre-show, we work with a lot of investors as a brokerage and a syndicator. So I think we're going to get a tremendous amount of value because this is a topic that's not really covered in much detail. So I'm glad to have you on the show to kind of, get more information out there and kind of inform us. But for people that are not too familiar with your background, would you mind just giving us a little bit of the story and a little bit more detail about your company?
Sure. My personal background, I actually have a background in education. I was a teacher for about 15 years. And recently, about 4 or 5 years ago, got really interested in real estate. And I'm a constant learner. So when I learn, because I'm a teacher, so when I learn something, I want to learn everything about it. And I want to just surround myself with those people who know the most about it. And so in real estate, I got involved as, in a brokerage, want to get my boots on the ground, just learn about how to buy and how to sell homes. And then I, wanted to learn more commercial. So I was involved with a commercial mortgage brokerage, a financing firm, so I could learn that aspect of the business. And then now recently I done some investing in the past. I'm getting into multifamily investing myself now, but really got into cost segregation. I kind of fell in love with this concept and the idea to save taxes. I think everyone loves to pay less income tax, right? And real estate professionals have, the added advantage over basically anyone else in the world when it comes to paying less taxes. So I found this company, Madison Commercial Real Estate Services, which has a number of branches. Madison 1031, we have a 1031 qualified intermediary service. We're a national title agent, due diligence, financial and environmental, and the SPECS division, which is the cost segregation company I work for. They're just incredible people. And when it came down to it, I wanted to just partner with this company and be involved in this great group of people. So that's a little bit about, our company overall. In terms of cost segregation, as I mentioned to you, we are one of the leaders in the nation. We have, an in-house team of over 50 engineers and tax experts, CPAs who come from all background of the big four, KPMG, PwC, all the big accounting firms, in order to, make sure our studies are totally compliant with the IRS guidelines.
Yeah, that's very interesting. And I didn't even know that your company was so diverse. It has so many divisions, part of it. So
Yeah,
that's very interesting.
yeah, it is. We actually have a few other divisions I didn't even mention, but a large company, I think at this point, over 700 employees altogether.
Wow, very impressive. Yeah, so for the topic of cost segregation, like I had mentioned before, it's not really a broad subject that you hear all the
Right.
time. So, and it's very important as I kind of started reading more about it, as I get more involved in my investments and my clients' investments. We always try to find ways to reduce taxes or just to optimize as much as we can with the property, and that's a big piece of that. So could you kind of explain for people who are not familiar with this term, what cost segregation is and the benefits it can do for your investments?
Sure, absolutely. So the first and foremost thing, let's just get over that name, right? Like, who came up with this name? I can't imagine like why the IRS chose this name. It used to be called component depreciation, which makes a lot more sense, because what we're doing is we are taking a building, a property, any type of property, and breaking down the depreciation lives to different categories. So we're segregating out the costs. That's where this name comes from. The value of the building, we're splitting up every tiny detail into, or segregating out those details into faster depreciation lives. So for example, commercial property depreciates over 39 years. A residential property, which also includes multifamily, depreciates over 27 and a half years. And these are totally like arbitrary numbers the IRS came up with, which tells us that there's something more to it, right? Depreciation, we understand the concept from something that has a useful life, right? You know that something, you buy a piece of equipment, it goes down in value after time because it's not as good anymore. You have to replace your stereo system, whatever, every 5 years. You have to replace certain items over a certain period of time. But a building, a property, so there's two things. Number one, it's actually most of the time going up in value the more you hold it. So it's kind of contradictory in terms. And the second thing is depreciation starts, this tax deduction that the IRS gives us starts the day that you buy the property. Okay, now if you're building a new property, new development, it starts when it's placed in service, meaning when it's ready to be rented out. But when you buy an old property, even if it was built in 1910, okay, it starts over that depreciation life of 39 years the day that you buy it. So it doesn't really make sense from a standpoint of actual value going down, okay? Nevertheless, the IRS gives you a tax benefit, a tax deduction based on that original purchase price. Okay, now most people, and normally everyone, is taking what's called straight line depreciation, which means you're taking that purchase price, subtracting amount for land, and that really depends on where it's located. Land does not depreciate, but whatever's left over, which is, land is usually 10%, 15%, 20%. There are certain locations where it's even higher, 50, 60%. But let's take 20% as a, 15, 20% as a normal land allocation, does not depreciate. What's left over, that's called your basis. That's what depreciates. You divide that up over 39 years, over 27 and a half years for residential again. That's a tax deduction you get from your income tax right off the bat. That is depreciation, okay? And I think everyone knows about that concept, at least if you're investing in real estate, you understand you get this extra tax deduction. It's great. It takes your, cuts right off the top of your income tax. Cost segregation comes in that an engineer, and the reason why you need engineers, according to the IRS guidelines, it's actually called the Cost Segregation Audit Techniques Guide, which, you can Google that. It's a great read, especially if you have insomnia. It will help you out. And in there, it delineates what constitutes a quality cost segregation study. And one of those things is that it should be conducted by someone who has an engineering background or has extensive experience in engineering and construction, because they need to see everything in the property, and they start to look at the building and look around and say, hey, this asset, according to the tax code, depreciates over 5 years. It's personal property. And there's so many things in the property that fall into that category, including carpeting, appliances, fixtures, furnishings, right? We know like furniture and appliances, we already know that's, personal property. It's movable, tangible property. It depreciates over 5 years, but there are so many things in a building, like even millwork and like certain, special purpose electric, lighting and shelving and cabinetry, things like that, that would basically go overlooked as part of the building. We can get an engineer who can identify those things, apply a value to them, and basically reallocate them to a faster depreciation life, getting you bigger tax deductions over those first 5 years.
As you had mentioned, like commercial and residential, is anything specifically excluded from that you can't do a cost segregation study on?
The only thing that's excluded is a personal residence. Okay, anything that's a investment property or a business property for that matter. Okay, a lot of people, might overlook that they have this opportunity if they own a business. Let's say they own, a manufacturing business and they have a warehouse or a factory. That building is a property. If you own that, you can do cost segregation on that building.
Yeah, it's a very interesting study. I'm very familiar with it, but it just doesn't seem like there's a lot of information. My thought, and correct me if I'm wrong, is that it doesn't seem like the IRS would be too happy for you to save on taxes. I mean, they're in the business of taking in taxes. So am I off on the wrong tangent there?
It's very interesting. It is interesting indeed. How is it and why is it that it's in there? And it seems like it is an incentive for people who own and invest in real estate. Now, don't get me wrong, it's great and it really helps people save taxes, but some people want to think, maybe the IRS or the Congress who passed the bills really have an invested interest, being that most of them are real estate investors themselves. Maybe that has truth to it. I'm sure it does. Nevertheless, most people don't take advantage of this. So even though it is, and in fact, cost segregation, according to the tax code, is the proper way of depreciating your property, to break it into everything into its proper category, whether it be 5-year, the personal property, 15-year depreciation life for that's land improvements. So anything outside the building like landscaping, pavement, concrete, fencing, signage, all that stuff actually depreciates over 15 years. The IRS says that's the proper way to do it. So even if you've been depreciating your property straight line, if you want to change that, you have to fill out a form that's called the 3115 form to go from, straight line depreciation to now doing it through cost segregation. And it's called changing it from an improper way to a proper way of depreciation. So it's very interesting. It seems like a little bit of a paradox, right? But I think Tom Wheelwright has a great book, and I'm not a huge fan of the whole Robert Kiyosaki and the Rich Dad. Everyone should read it. I think it's great, but he's one of the Rich Dad advisors. He has a book called Tax-Free Wealth, and in there he has a whole chapter on depreciation, and he says something to the fact of the government knows that the taxpayer and or their CPAs, due to their laziness or ignorance, right, the government is basically going to be getting a lot more money. And so the U.S. Treasury has an interest, creating these laws so that people who, are smart enough to take advantage do, but most of the people don't. And so they're actually, taking less depreciation than they actually are entitled to. They don't tell you about this. They just say, okay, do straight line, right?
Exactly. When we a good time to say engage with a company like yours? Could you be able to say if someone's in the process of analyzing a deal to see if you can see what type of cost savings are there? Is that a good time, or after you actually own the property?
Yeah, really, the best time is really any time. If a person is under contract and they want to look and, like you said, analyze the property, we offer a free feasibility analysis, which means our engineers will look at some details of the property and give their projections of what the tax benefits would be if you did a full cost segregation study. So that's upfront, that's free. A lot of people like to see that because they like to see what the potential tax benefits are going to be, what their cash flow is going to be. Because remember, we're creating extra deductions, hopefully cutting down our income tax liability to, very low, if not to zero. So what we're doing is not just looking at our NOI when we're analyzing, underwriting the property, we're actually looking at our real cash flow from the property in those first early years.
What's kind of like a general range people can expect as far as costs for like a study like this?
The cost of a study, we charge a very, flat rate based on the scope of work, and it's kind of a range between, anywhere between $5,000 to $7,000 based on the type and size of property, location sometimes. If it's a massively large commercial property, it will be more because there's going to be a lot more work involved. We've done a number of skyscrapers, billion-dollar plus assets. We're talking like 1 million square foot. We did 1 million square foot Amazon distribution center in Florida, right? That was a lot of work that was involved in that. It costs a little bit more, right? Because it's really relative to the time and the effort involved in that. But that's generally the range for most commercial properties. Again, it does not depend, it's not contingent at all to the tax savings. So that's really an important aspect to it. There are some firms and there are some people out there that are charging on the tax contingency. We'll take 10% of your tax savings. Well, guess what? The IRS frowns on that because basically you're like coming to the IRS and saying, hey, I'm getting extra tax deductions and I'm getting paid. So I'm having vested interest to create more deductions. So that's looked at very poorly and can actually be, met with a lot of fines if that's found out.
Yeah, I have a lot of multifamily property owners. They probably range in, I would say, the 1 to 200 unit range. So they had asked me some questions to ask you. Do you know what kind of a typical time frame does a study like this take?
Generally speaking, like I said, the analysis that we'll give up front, that's free, and we, usually turn that around in a day or two. But the actual study, we always send an engineer to the property to walk the property, and it doesn't matter where it is because we work in all 50 states. So, we have our bases covered. We have 16 full-time engineers on staff who are, going around across the nation, are located in different places. But it usually takes between 4 to 6 weeks, generally, just for us to, to get out there, to come back, review it. We always review it 4 times just to make sure, 4 different people are reviewing it, making sure everything is in accordance to, the study, to the code. And yeah, that's usually the expected turnaround time. Although, if in extenuating circumstance, we can get it done, in a much faster time.
As far as for people doing like 1031 exchanges, what's the benefits with working with folks doing those?
So there are 2 really important things to know when doing a 1031 exchange in combination with cost segregation. So the first thing to understand is that when you exchange into a new property, your depreciation goes along with you, meaning whatever you already depreciated on the previous property, that basis is carried over, which means that if you, let's say you bought a property for $1 million and you depreciated $100,000 of it already, okay? Now you go and exchange it into a new property. Let's say you sell that property for 1.2 million. So your gain is really 300,000 because there's a 200,000 gain plus the $100,000 of depreciation that's carried over. That's subtracted from the new property, the upleg property that you're exchanging into. So that will give you a lower basis than had you just bought outright a $2 million property. Your basis would just be based on the 2 million subtracting land. In this case, you're going to subtract the gain, including the depreciation that was already taken from the previous property. So that's the first thing to understand. Your depreciation is always going to be less because it's carried over from the previous property. The second thing to note is that there's something called depreciation recapture tax. When you sell a property, the IRS hits you with a tax saying, hey, yeah, we gave you this great gift of not paying taxes or paying a lot less taxes during the course of ownership of the property, but now when you sell it, we're going to tax you, up to 25% on that amount that was taken. And something a lot of people don't talk about when they talk about cost segregation, but it's important to note. The great thing about 1031 exchanges is that when you go through a 1031 exchange, not only are you deferring capital gains tax, which everyone knows about, right? You're also deferring that depreciation recapture tax. So you're carrying it forward and you're getting that added benefit of deferring those taxes that you had beforehand. So getting a cost segregation study done is really a great thing, combined with 1031 exchanges. However, and I'll note this because there's a new thing that came about with the tax reform that, and this is really subject to debate, so I'm not going to get into too many details because there's really two ways of looking at this, two schools of thought. But the new tax reform in 2017, the Tax Cuts and Jobs Act, passed a law that said 1031 exchanges no longer applies to personal property, okay? Now, they didn't word it in the coding of what's called 1245 property, which is usually what's segregated out from real property, from 1050, from real property in a cost segregation study. They just said personal property. So most people understand that to mean that you can no longer 1031 exchange a plane or a car, right, or expensive piece of equipment or what have you, a Jimi Hendrix guitar or whatever. You can no longer do that, right? What that doesn't, and this is really where the debate lies, is that does that also apply to the personal property that's within real estate? So, for example, the appliances and the furniture and the fixtures and stuff that's in my property, can I 1031 exchange that into the new property? So there's where there's a big debate.
That's definitely interesting. Yeah, absolutely. Seeing that this is legal, the studies and everything, is there any chances of being audited by the IRS for doing studies like this?
There are no real chances of getting audited for doing this, but if you do get audited for another reason, then for sure this is going to get looked at. So you want to make sure that it's in line, everything is done according to the rules. So you want to make sure you're dealing with a firm that is preparing a study that goes through all of the 13 principles of a quality cost segregation study. And one of those is that it's done by an engineer. The second thing is has a certain numbering system and nomenclature. It's like a whole thing, right? So you want to make sure you're not just like coming up with a number and saying 20% of my building is 5-year personal property, I'm just going to accelerate that depreciation. That's a no-no. You're not going to, if everyone were to get audited for that, they'd for sure fail. So it comes with penalties and fines according to that as well.
Yeah, kind of leading into my next question, we're kind of based off of companies that said they would do it off the amount of taxes they'll save you and different stuff like that. What are some of the stuff that you should be looking for in engaging a company like yourself?
Madison SPECS, I think we have a name in the industry. And so you want to make sure someone has experience, right? That they're, number one, they're going to stand behind their work. So if you were to get audited, they're going to stand behind it and support it. In all the 13 years that we've been in business, the number of times that our clients have been audited, we have, 100% no change on our studies because it totally fits and goes with the, rulings of the tax code. That's number one. You want to make sure they have a lot of experience, right? You want to make sure that their accountants are reviewing things internally. They're not just, doing one-off. And obviously look for recommendations, speak with your accountants, with friends, colleagues who are in the business who are doing it, see what their experience has been. In my opinion, that's always the best way to do it. So those are a couple things to look for.
As far as say a new construction build, and then you have the contractor delivers you all of the costs of the items and then submit those to your CPA. Do you still have to kind of do a cost segregation study with your company like that, or is it a different scenario?
Yeah, no, you should do a cost segregation study because that's the proper way to deduct all of those things. Now, some people may be able to figure out a lot of those deductions based on the invoices, from the contractor. They with their accountant, if it has experience, may be able to do a rule of thumb and come up with those costs based on the invoices. However, in my experience, having that full study and having all the, following all of the requirements is a much better way to go about doing it because it's, number one, it's safer if you were to get audited. Number two, we can usually find 20 to 30% more benefit from all those things that you may not even think apply to that 5-year period. And, based on the experience we have in finding out all the values of things in and outside the building, our engineers can really determine a tremendous amount more value than you maybe even think.
And as far as your company, are you working with clients nationwide, or is it specific locations that you key on?
Yeah, we're nationwide. So we have, like I mentioned before, we worked in all 50 states. Last year, we even went to Hawaii 3 times. But we have, we have engineers, 16 full-time engineers, and we're located in different locations so they can really crisscross, to anywhere in the nation. And last year alone, 2018 alone, we did close to 2,000 studies. So we really have, the volume and the spread across the nation.
Wow. So you had mentioned before that just even on this analysis side, it's a good idea to talk to you. Is there any other process of engaging you, and kind of what are the next steps if somebody want to kind of talk to you guys?
Yeah, if anyone wants to reach out anytime, whether it's if they're under contract, whether it's they already purchased the property, even if they had a property that was purchased in a previous tax year, 2, 3, 4, 5, even up to 10 years ago, you can retroactively, get the benefits from cost segregation. So, feel free to reach out. You just need some basic information about the property to give that upfront analysis. And it's pretty straightforward. It gives you a real benefit to get that educated decision. You kind of see the numbers and you can compare it. See, well, hey, will this make sense in my situation? And it does not make sense in every single situation, but at least to have those numbers in front of you to be able to, make that decision.
Yeah, connecting with you, just talking with you in more detail, it's a no-brainer, just to at least see if it makes sense moving forward. So you guys provide an excellent service, and I appreciate you giving us all this information. So how do we get in contact with you or your company if they want to get in touch with you?
Yeah, feel free to reach out to me. I'm very active on LinkedIn, Bigger Pockets. Those are 2 places I'm pretty active on. You can reach out to me there. I'm posting every single day, so I'm active. If you reach out to me through that, I'll find you. You can reach me via my email. Again, I handle a lot of the incoming business, so client interface, etc. My email, yweiss@madisonspecs.com, and my phone number I'm sure to put in the show notes over there as well.
Excellent. Yeah, so it's madisonspecs.com. Their phone number is 888-773-2773. And again, Yonah's on LinkedIn, Bigger Pockets. Reach out to him if you have any questions. Yonah, thank you so much for reaching out. I really appreciate the discussion. Tremendous amount of value that you deliver to our audience, and we look forward to connecting with you again soon.
Thank you, Dwaine. It's a pleasure.
Right. Take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.